Chapter 13, Investment Analysis. Video 1, Fundamental Analysis in the Balance Sheet. In this video, we'll be discussing fundamental analysts' use of financial statements, balance sheets including its assets and liabilities, and calculating quick current and debt-to-equity ratios. Fundamental analysis derives the value of securities through the available public information regarding a corporation's financial status. A fundamental analyst uses financial statements to make comparisons of companies in the same industry. A fundamental analyst will examine some of the qualitative basics of the operation. This includes the outlook for the specific industry the company represents and its management team and style. The analyst will not only examine the product line of the company, but also anticipate any new products on the horizon. They'll also take into consideration the market share the company enjoys. Analysts want to quantify with numbers to determine if a security is overvalued or undervalued in the market. To achieve this, analysts will look at the balance sheet and income statement. These reports are available to the public through the annual 10-K SEC filing and are also sent to shareholders annually. All financial statements include footnotes. Footnotes allow the issuer to include additional information or explanations for specific items contained in the financial statements. Footnotes might explain the circumstances that cause changes in the financials or how items are valued. They can provide additional information about debt instruments like when the debt matures or when payments begin or cease. The depreciation and inventory valuation method can be found in the footnotes, as well as detailed information on lease payments. All this additional information helps investors and analysts understand and interpret the financial statements. The balance sheet is a snapshot of all of the company's assets and liabilities at some point in time. Assets are listed in the left column of the balance sheet and liabilities are on the right. They're listed in terms of liquidity for the assets and in terms of debt for the liabilities. The formula for the balance sheet is assets minus liabilities equals net worth. For the balance sheet, monies receivable within 1 year are considered current assets. They are liquid monies receivable in the near future. Along the same line, liabilities due within 1 year are considered current. Current assets include cash and accounts receivable, marketable securities, and inventory that is expected to be converted to cash within the next 12 months. Current liabilities include accounts payable, wages, accrued taxes, and the portion of long-term debt payable within the next 12 months. As previously discussed, current assets are those expected to be converted into cash within 1 year. Long-term or fixed assets are those a business does not expect to use or convert to cash within a year. They are listed after the current assets on the balance sheet. Notes receivable over 1 year are generally debt investments of the company. Any interest from these securities will show up on the income statement. Next come the fixed assets. They include property, buildings, and equipment. They'll be stated at their acquisition cost, but any depreciation taken will be subtracted, resulting in their net depreciated value. Depreciation is the recovery of the value of assets that is lost over time. There are 2 methods of depreciation, either straight line or accelerated. Accounting rules allow a company to choose which method they use. Straight line takes the deduction in even increments over the asset's life. Accelerated depreciation is a method that front-loads the depreciation with bigger deductions in the first years, reducing deductions as the asset ages. Land is the only fixed asset that does not allow for depreciation. Depletion is the method used for real property costs, such as the costs associated with raw land and intangible drilling costs. Intangible assets consist of trademarks and goodwill. Goodwill is the amount a company is sold for in excess of its book value. It encompasses product lines, company base, branding, etc. Total assets are simply adding up all the things we've mentioned, but a company may also be valued at more than just their book value. To find the value of a company's tangible assets, we simply subtract the intangible assets from the total assets. Looking at the right side, we have the long-term liabilities. Long-term debt is also sometimes called funded debt, as it's the source of long-term funding for the company. This is debt that must be paid in more than a year. In its simplest form, long-term bonds. For stockholder equity, the equity of a common stock is broken into three components: common at par, capital in excess of par, and retained earnings. Preferred stock is issued at a stated par value. Now, this is not the same as the par value of a bond. Usually, par of preferred stock is $100, but it can vary. In theory, all earnings should be distributed to shareholders. Earnings that are not paid out to the shareholders as dividends technically belong to the shareholders. The company has kept them for business operation purposes. These must be accounted for and shown on the balance sheet as retained earnings. Total liabilities and shareholder equity combined with the right-hand side of the balance sheet will be equal to the total assets from the left side. So now that we have all this information, what do we do with it? We analyze. Net worth equals assets minus liabilities. In other words, net worth consists of things of value minus what the company owes. You may see the same formula presented to you in another fashion. All these formulas say the same thing. They're just arranged in a different order. Net worth is just one of the things we can calculate from the balance sheet information. Certain ratios and formulas are used to analyze a company and compare it to other companies in the same or similar industries. Net working capital is calculated by taking current assets minus current liabilities. It shows the corporation's ability to pay its bills. Two ratios used to measure liquidity are the current ratio and the quick ratio. The formula for the current ratio is current assets divided by current liabilities. This ratio shows how many times a corporation's current assets can pay its current liabilities. The quick ratio is current assets minus inventory divided by current liabilities. By removing inventory from the calculation, the ratio indicates what can be quickly converted to cash. The quick ratio is also called the acid test ratio. The inventory turnover ratio determines how fast inventory is sold compared to the company's net sales by dividing net sales by the average inventory. The average inventory is found by taking last year's inventory plus this year's inventory and dividing by 2. A fundamental analyst will examine the capitalization ratios to evaluate the company's capital structure. For example, if the company is highly leveraged, meaning debt is a large proportion of capitalization, covering interest charges might be difficult if income falls. Capitalization is the total amount of money invested in the entity. To calculate the capitalization, simply add the common stock sold, plus preferred stock sold, plus the amount of outstanding debt, plus any retained earnings. Shareholder equity consists of 3 components. Common at par value is the amount paid by common stockholders who bought the shares on the initial public offering that is attributed to the arbitrary par value per share. Capital in excess of par is the amount above par value paid by common stockholders who bought the shares on the initial public offering. For example, if the arbitrary par was $1 and the stock sold for $5, it would have $4 in excess of par, and it would show up on the balance sheet as such. Retained earnings are corporate earnings that have not been paid to common shareholders as dividends. Rather, they're being retained by the corporation and used to fund future growth. Now we have the debt-to-equity ratio, which is simply the company's long-term debt divided by stockholder equity. This ratio shows if a company is highly leveraged. This ratio could be very important to a person considering buying this company's debt securities. A debt-to-equity ratio of 2 means a company has twice as much debt as equity. A debt-to-equity ratio of less than 1 means a company has more equity than debt. Another ratio that will show how leveraged a company is the bond ratio. With this ratio, we divide the long-term debt by total capital. The book value per share shows the net worth of a company on a per-share basis. When all assets have been sold and liabilities are paid off, what's left is shareholder equity. Divide the shareholder equity by the number of common shares outstanding and you get the book value per share.